So the question with any asset bubble is how the asset price responds to a change. And when we have a bubble in an asset price, and we've had bubbles in asset prices going back hundreds of years, is whether or not when the price goes up, people feel like, oh, that's going up for a reason, and so I'm going to buy more of it because I expect the price to keep going up. Or whether when the price goes up, people say, ooh, that's kind of expensive, I'm not going to buy that, and then the price goes back down. And so we can have either a positive or a negative feedback loop. And so what we have is a positive feedback loop here on the left. And that means basically, so what we have, this picture is basically showing the price in one period, period t on the horizontal axis, with a price in the second period, t plus 1, on the vertical axis. And what's going on with the positive feedback loop is that each increase in the price leads to a higher increase the next period, right? And so now people are saying, ooh, that price is going up. Ooh, and look, it's been going up and up and up. I'm going to buy and buy and buy because you expect it to keep going up. Um, and obviously that is unstable, right? And so eventually it's going to fall. Um, and when it does, it's often going to fall very quickly, depending on the asset. Housing prices fall less quickly than, say, stock prices, but it's going to fall. Whereas if we have a negative feedback loop like we have on the right-hand side, then an increase in the price actually leads to a decrease in the price the next period because people think, oh, that's too expensive. That's not going to stay high. And so it's a bit of a mystery in terms of why some assets experience positive feedbacks and others experience negative feedbacks. And sometimes it can be the same asset that experiences these different feedback loops at different times. So if we think about how to model this, we could think about this as kind of an S curve where, again, we have the price in period t on the horizontal axis and a price in period t plus 1 on the vertical axis. And the idea here is that where we're at point A, where the price is the same in both periods, if it goes up, we could end up with a positive feedback loop, in which case we get a bubble until we get to price B. Whereas if we get a price decrease, we could get a positive feedback loop that ends up with a negative price until we're at C. And B and C are both stable, so they both have negative feedback loops. So any change in the price will get pushed back to B or C. And so one possible way to think about modeling this bubble is that we had a shift in expectations. And the reason for that is that any asset price can't keep going up forever, right? If it hasn't become much more productive than it was in the past, then probably it's not going to change its value so much. And so if that's true, so if the returns, if they're going up less and less, then expectations can shift that S curve down, right? And so now we don't expect it to go up by as much. And eventually, if we get to point Z, then there's no real equilibrium until we fall all the way down here to point K. And then we get an even lower equilibrium than we would have if we were at point C from the previous graph. And so that really seems to be what happened in both the stock market bubble in the Great Depression and the housing bubble in the Great Recession. And so what we see is that, if we think about a housing price index, it reached a peak in 2006. By 2007, it had fallen by 8%, and by 2008, it had fallen all the way down by 24% from its peak. And so there was this big drop in housing prices, which caused a big problem because those banks, a lot of their assets were wrapped up in housing prices, not necessarily mortgages directly, but mortgage-backed securities and other collateralized debt obligations. And so those banks needed to be bailed out, which was successful, but still created, a big financial crisis and recession. So just like as in the Great Depression, consumption fell significantly, residential investment fell significantly, non-residential investment fell significantly. But unlike the Great Recession, the first response was to increase government spending, to decrease interest rates, and we recovered pretty strongly in 2009, 2010, although, compared to the Great Depression, we recovered strongly. Compared to other recessions, the recovery still took uh, some significant time. So if we think about what was going on, in the 1990s and 2006, expected future income probably didn't change that much, but home equity increased and debt increased a lot. And the problem with the financial crisis was that the home equity fell significantly, the debt doesn't fall that much. So once again, just like in the Great Depression, now people are going to spend less, they're going to save more, and that's going to, cause that paradox of thrift and cause the big decrease in GDP. So banks played a big role both in the Great Depression, where they lent money to buy stocks, and in the Great Recession, where they did what they've always done, lent money to buy houses, but they also created these new assets, mortgage-backed securities and other collateralized debt obligations, in order to sell them off to different investors. And when the housing market fell and they were still holding a lot of these assets, they were very highly leveraged, right? So only a small fall in their assets could lead to insolvency. And nobody really knew what these mortgage-backed securities were worth because nobody was sure how far the housing market was going to fall. And so government had to rescue the banks. They did this both through lending, through the bailout of AIG, um, which basically funneled money through AIG to a lot of these banks. And that led to a lot of finger pointing and also a lot of acknowledgement that we had sort of created excessive risk taking within the banking sector. So if we think about just a summary of these three eras, the Great Depression was definitely a demand side crisis, although that demand side crisis kind of was fueled and caused as well by a banking crisis. The Golden Age ended with a supply side crisis when productivity fell, profits fell, investment fell, and the financial crisis was really caused by the banking crisis from the housing bubble. And so, if when you read the chapter, you'll see that there are a number of economists highlighted who learned different things from these different periods, and that's kind of what macroeconomics is all about. Somewhat unfortunately, perhaps, is that we're always learning from the last crisis and not always getting prepared for the next crisis. And hopefully, we keep these lessons in mind as we go forward so that we're not as surprised when something bad happens.